Our next guest believes retail investors should consider riding out the market momentum. Julian Emanuel is Evercore ISI's Senior Managing Director. Julian, great to have you with us. Your price target is $44.50. So, right, you just raised it?
Yep.
So we're within striking distance.
We are, and we made the point. And look, I think we have to acknowledge this conversation so far in the hour is that this is an unusual market, a kind of market we have not actually seen since the late 1990s. Okay, this is momentum taking over. This is really getting around the whole AI concept in an environment where positioning, and this is actually quite remarkable when you think about CPI tomorrow as a risk point, and you think about the Fed, even though it's pretty clear that the Fed is likely to pause and then probably hike once more in July, and the markets bake that in. But to think that there are record net shorts in equities, record net shorts in bonds, record quote unquote longs in cash, and volatility has dropped to near zero, the lowest levels of the pandemic, those kind of imbalances tell you that, and we made this clear in our upgrade, that the 44.50 could get here by the 4th of July. Frankly, after today, we may not get there. We may get there before Father's Day. And from our point of view, where the market goes from there is dependent on how close we perceive we're getting to the recession that we think happens at the end of this year and into early next year.
So, Julian, let me ask you, if we see a hot CPI number tomorrow, is that supportive of the market or is that a problem for the market?
Well, it shouldn't be supportive for the market in theory.
That was the question.
But the market doesn't care about that right now, okay? So particularly since the basis effect is starting to hit. So the last year on year was 4.9. They're looking for 4.1 now. And frankly, if you look at consensus, it could go either way. But even if you were to come in a little hotter, 4.2 or 4.3, the bulls are going to say, OK, it's coming down. It's going the right way. And we believe that as well. We actually think that you could get a two-handle on inflation by the time you get to early next year, which is clearly stock market supportive. But again, the market is moving on things other than macro. It's a lot of momentum, very difficult market, and big difference whether you're an institutional investor or retail investor. The institutional investors who had, pretty poor years last year, it was a bear market, as we know, and who are underperforming this year may be incurring business risk and have to participate in the upside, whereas a retail investor, we've had this conversation, you're getting 5% on your cash. You don't have to do a darn thing.
All right, nice job on your call. But let me ask you this. Did the stock market at its lows in October, and it really meandered around for the Q4 a bit, some of the biggest stocks in the NASDAQ were making lows, 52-week lows in early January, right? And so we've had this big rip. Does the pessimism that we saw late last year, does it basically discount a recession? Because you think you just said you think we're going to be in a recession by the end of this year. Is that already discounted?
No, we do not buy into that, which is why, again, this is a time that's fraught with peril, because the most important statistic we saw was last Thursday. The weekly jobless claim series broke out to the upside. If that continues, we will be much closer to the start of a recession than people commonly believe right now, because they're being lulled by the market action into believing it's further off. That's the point to us where you will have maybe not all of the indices making new lows, but you'll have a number of them feeling as if they're going to. And it's really the same effect.
Choose 10s went from 110 basis points to maybe 40-ish, back to 86 or so now. Is that telling you anything, or should we not even be paying attention?
The noise around the yield curve is just monumental. From our point of view, we're working under the assumption that 111 under was likely the trough of the inversion. Therefore, actually, if you look at history, starting the countdown to the recession, which gets you towards our view of late this year or early next. And the problem the market's having is there have been times when it happens concurrently, and there's a lot of things that say we should be in a recession already, but we're not. But then again, there's 98 to 01, and it took almost 3 years for the recession to hit.
So if the October lows was not, if they did not discount the recession scenario, then where do we go once we do see a recession or just prior to it from your 44.50?
So we think, again, that there is likely to be a period of weakness that, at a minimum, will challenge the floor that we've seen for the most part of this last 6 or 7 months, below 4,000, probably 3,800 in the S&P.
Wow.
But think about it.
I mean, that's putting it politely.
That's not. I mean, that's down 12, 13% from here.
It sounds like you're talking about down 12 or 13% in a fairly short amount of time.
If the market gets carried away in terms of sentiment, we saw the bulls ratio break out. We've seen volatility on the lows. That's where we worry about public getting bullish at 4,400, 45, or 4,600, where they'd be better advised to start thinking about lightening up.